here with you. It's been an interesting couple days. Let's put it this: dating back to last week when you had Silicon Valley Bank and then Signature Bank in New York closing their doors or getting taken over by FDIC. Bank stocks got hit hard on Monday. Tuesday, today they kind of recovered a little bit and back to normal as fears calmed a little bit in a rational market. But it's funny hearing things out across the other, like the fact that Wells Fargo wasn't allowing people to pull money out of their bank account over the weekend and called it a glitch. That's interesting. Do we think Wells Fargo is up to their funny business like usual? Probably so. But anyway, I will tell you right now, getting straight to the point here, every banker in the country is evaluating their portfolio right now. Everybody is looking at their residential and their commercial loan book. What's good, what's bad, what's ugly. And there's never been a time as we get to the end of the first quarter, and we predicted this last year going into the fourth quarter and the end of the first quarter as opportunities. Now as I'm recording this, we're still 2 weeks out from the end of the first quarter of 2023. It will be we're basically a month out till we get the numbers and then how Q1 shaped up for everybody. But I guarantee that is a number, those numbers with Bauer Financial or what they end up filing with the FDIC is going to be very, very interesting for note investors. So that's why I'm doubling down the next 2 weeks, the next 4 weeks on asset manager outreach. What am I doing? Yes, I'm doing my continued outreach on LinkedIn to special asset managers, secondary marketing professionals, whole loan traders, chief credit risk officers. Reaching out to 50 to 100 people on LinkedIn through Octopus CRM each day. I'm also pulling up my asset manager lists and sending an email blast out to the whole list on a regular basis. I'm pulling different lists that we have pulled from different large servicing or large secondary marketing conventions. And yes, if you've taken my class, you would know how to pull those big lists of first name, last names, job titles, company names, and email addresses. And that's one of the big things I'm telling my one-on-one students, like make sure you follow up with individual emails. Mass email blast is better than nothing, but sending a personal email to the head of capital markets or the head of secondary marketing or special assets or even the CEOs of these lending institutions has power because everybody is looking at their books and are like, rattled. Even though you could simply say that what happened with Silicon wasn't necessarily a bad mortgage default issue. It was more so with how they allocated their capital into bonds at low interest rates. And of course, with interest rates going up, the values of those bonds depreciated and the lack of deposit they coming in. That's why the FDIC went in and shut them down. It's also interesting to see what happened with Signature Bank in New York, because obviously they got shut down more so with issues and kind of the FTX hangover or the cryptocurrency hangover, a lot of things. But what I found interesting, there was an article out Friday afternoon about several hedge funds that were actually reaching out to institutions at Silicon Bank who'd had their accounts frozen and offering to buy their assets or buy their frozen accounts for 60, 70, 80 cents on the dollar. Totally reminded me of Mr. Potter from It's a Wonderful Life, who, don't worry, George, banks, we'll be glad to take her. Bring your deposits over. We'll give you 20 cents on the dollar. Totally reminded. I posted something on that on LinkedIn. And of course, Larry Hoffman says, that reminds me of Mr. Potter. So yeah, that's kind of what made me think of those guys, the big funds. But here's the thing. There have been rumblings for a while now in the markets. When you look at major companies like Blackstone and I can't remember what the other company name, the big hedge fund in San Francisco that defaulted on a large multifamily trade. Multifamily's been one of the peak asset classes for the last couple of years, really one of the most overpriced asset classes. But if you're getting cash flow and you've got a high occupancy high occupancy, low vacancy factor, like most of the major cities out there, it's a surprise that these asset classes or these apartments are defaulting. And it comes down to the fact is that things are changing in the market. And we kind of talked about this before because it's history repeating itself. When I started off as a note investor back in 2007, 8, and 9, one of the first things I did was I started reaching out to banks, started calling, dialing 50 phone calls a day, dialing 100 phone calls a day. I'm probably going to be doing a lot of that over the next few weeks. And probably live streaming it so folks can watch me do it, or we'll do a special class about that. But that's one of the things we were buying. We were seeing 20, 30, 50, 100, 200 unit apartment complex. Even 300 was the biggest one we'd ever bought. Struggle as they ran into rate spike or the need to bring 10, 20, 30% cash to the bank to write down their loan to get it back to 70% LTV. As values change, cap rates change, if your net operating income changes, your profits change, that reduces the value, reduces the cap rate, and you have an issue where you've got to bring money to the table to make the bank happy. Otherwise, they're going to do a default. I would go back and watch the Note Night in America episode I did with Credit IQ last year, how Credit IQ is able to track default rates on commercial property, specifically multifamily, mixed use, and a whole smorgasbord of commercial assets out there. I'd be willing to bet they've got a lot. They're seeing a spike in defaults in the last 6 months. So these things lead to opportunity. Now, I had somebody reach out to me today. Hey, I want to buy off-market multifamilies. Look, you're not going to, anybody that's got some money is going to be gobbling up still that asset class if they're buying it at a discount. Okay. This is why buying the note makes a lot more sense, because we're buying at a bigger discount, and you can kind of control that process of whether A, you're going to foreclose, or deed in lieu, cash for keys if the borrowers can't refinance that. That's the opportunity play, is to take over some of these assets and put in your own management class. You'll see that in some self-storage stuff. You're going to see that in some mixed use. You're going to definitely see that in some office space. You just got to be very careful of the office space, because you got to know what's going on in your market. Is it oversaturated like some of the bigger cities out there? Or is there a big need? Or can you pivot that asset class into something that is needed? We've highlighted in the past how several executive offices, parks converted to self-storage units or office self-storage, where they filled up with office furniture from the businesses that are going out of business. Big box stores are struggling. Malls are definitely struggling. There's a lot of commercial assets out there that are struggling that aren't on the hook from Wall Street. They're on with your smaller regional banks that are struggling. That's why some of those stocks were hit hard, because that's the quick knee-jerk reaction to a lot of things like what happened with Signature and SVB. Okay. But look, this is an opportunity. This is the time to double down in marketing, as people are a little nervous, a little scared. Every asset manager is going to be looking at their portfolio the next 2, 3, 4 weeks and saying, what can we move our books that will help us get healthier? They may have healthy, but every bank I know has some non-performing stuff on their books. So they got some stuff that's got some hair on it. All right. Got some ugliness that they need to move. It may not be the most amount of assets, but these are the times to act, as Warren Buffett said years ago, when everybody's running one direction, run the opposite way. Okay. If you've been sitting on the sidelines waiting to take action, now's the time to get in the game. Now's the time to really take action and get the ball rolling in your note business. I mean, I had a guy today who's been trying to find deals in San Antonio. He's been trying to find deals in Dallas, can't find them what he used to. And so he finally said, I've been wanting to do this for a while, but I've been putting it off because I've been lazy, because I've been able to find onesie, twosie deals here. I'm like, well, the time is you got to go get out and start harvesting. You got to start planting some seeds and making some things happen. But this is a great time to do it. Just a quick pointer, our 3-day virtual workshop, we host that once a quarter. It's coming up in 3 weeks. You can check it out at notebuyingfordummies.com. It's $9.97 for you and a spouse. Love to have you take that class. Great time to dive in and get your feet wet, because there's so many amazing deals that are already starting to pop up. We're seeing tapes. We're seeing servicing companies. We're seeing asset managers. We've seen an influx of people calling me, hey, what are you buying? That's the people thing. This business isn't so direct mail driven. It's really not direct mail driven at all. I had a conversation with a guy today. He's like, I want to send out letters to people that have originated owner finance loans. That's great. You can have that low return. I'll get a higher return with my email blast and my LinkedIn connection. So I'm doubling down on asset managers. You should be reaching out to them too. This doesn't mean walking to your local Bank of America or Wells Fargo and ask to speak to the bank president. Most VPs at a bank are just it's a title. It's a facade title. I was a VP at Chase Bank. Woo! Vice president. Whoopie freaking doodah. Didn't mean I could make any decisions. It means I didn't even know where the bank notes were. We were on the origination side of the deposit sides. You've got to go up. You've got to reach out to special assets, secondary market, reaching out to the corporate offices. If you've got a bank connection, Not just a local bank president is going to open a checking account for you, but some of the upside in the management, CEO, COOs, chief operating officer, capital market, secondary market, special assets. What are those? It's worth reaching out and saying, hey, what do you have in your books that you're looking to get rid of? That, are you looking to tidy up your books? Let's talk, because I'd be willing to bet that here this next 6 months, they definitely want to get the stuff off their books, because the small, especially commercial banks, if they're holding commercial asset classes, it's going to get rougher than before it gets better. And many of them would be willing to make deals, probably, like I say, sweetheart deals that you're not going to see except once every few years. So that's the big thing. That's part A, reaching out to asset managers. The second part is doubling down your marketing to raise capital. There's been a lot of scared money in the markets the last year, 2 years. It's time for you to find the deals, and these are the opportunities to put people's money to work. You ain't got to give them a great return or out of the park return, but give them a fair return, 6, 7, 8%, depending on what they bring to the table, passively for 24 to 36 months. Set your deals up to be at least preferably 3 years or longer where you're holding that capital. You can always cash their money out if you close the deal out, sell it off, foreclose and stuff. But if you regentrifying an asset, modifying, restructuring that loan, you want to build in that ease to have that capital working for you for a period of time. Because guess what? Most people have money. It's an IRA. They can't do anything with it anyway. Actively, it's got to be passively. You might as well put it on autopilot for them to get rock and rolling. So I just wanted to share those two big nuts. Obviously, doubling down our marketing to asset managers across LinkedIn, emails, and direct emails, and even phone calls. And two, reaching out to asset managers. I mean, one thing, I'm not asset managers, sorry, IRA investors. We just recently pulled, we took a list of the top 25 counties in Texas, and we did a quick search for three names on the county records, the appraisal districts, made it really low hanging fruit. Well, out of those top 25 counties, we found over 2,000 IRA investors, names, addresses, and now we're about to do the skip tracing part to find phone numbers and email addresses for those. And so that's something that we're really doubling down into to raising capital here, a lot of capital in the next 6 months. To take advantage of what's available here. In the same time, we're working through about a dozen notes, about $250,000 in funding, which equates to roughly about 35 cents on the dollar or 40 cents on the dollar of UPB. So we're getting some pretty steep discounts already. So if you're interested in finding out more, feel free to reach out to me, Scott at WeCloseNotes.com, or book a call at talkwithscottcarson.com. But now's the time. Talking to bankers and talking to investors. Get the deal done. You control your destiny. Now's the time to make some hay. Now's the time to quit saying, oh, I'll get into it when I'll get into it. Now's the time to get into it. Because if I think back to history, if I had really started doing this back in 2007, early 2008 full time, I'd be in a whole lot different asset class. And it's the same thing. I plan on buying a whole lot more assets this time around than I did last time. And I really see some opportunities in the non-performing note side. There will be some opportunities in the performing side, scratch and dent stuff, but the real big bang for your buck is going to be in the NPN side. So come on, join the sexy side of real estate. Come on, join the sexy side of investing and become a note investor. And hopefully we'll see you in one of our classes or a workshop, or just keep listening to the podcast. And as always, guys, if you're listening, make a comment. Let me know you're watching. I'd love if you left me a 5-star review on anywhere that you listen or watch the podcasts. Or make sure you hit subscribe to our YouTube channel at WeCloseNotes.tv. But go out, take some action, buddy, and take some action. You're likely bound to see some action.